a warm welcome again to the audience and to our distinguished panelists. We have had a very lively and a very inspiring first debate about crypto assets in general, stablecoins in specific, and the respective legislative initiative by the European Commission, the Markets in Crypto Assets Regulation. What we would like to do is to take this discussion now sort of one step further. And one of the watchwords that has come up time and again in this first panel is one that I think will also be quite relevant for the second panel, which is trust. So we've heard quite a lot about how these new instruments that sort of emerge on the scene, that have emerged on the scene already, these crypto assets, these stablecoins, how they rely at the end of the day on trust by its users. And I think this is sort of very much what leads us into this sort of second discussion. I would like to welcome our panel. I will start with Jürgen Schaaf. Jürgen is an economist and a senior advisor at the European Central Bank in the Markets, Infrastructure and Payments Director General. He has been a counselor to the Executive Board of the European Central Bank, and by background, he's an economist. Moving to a second panelist, we have Gabriel Söderberg from the Swedish Riksbank. Gabriel is a senior economist at the Swedish Riksbank, who is very closely involved in the central bank digital currency project there, and in the discussions about the future of money and the payment system. He's also an associate professor at the University of Uppsala for economic history. Gabriel will transition at the end of this month from the Swedish Riksbank to the International Monetary Fund, the IMF, and will continue working there on central bank digital currencies. Our third panelist is Virgile Perret. Virgile works at the University of Fribourg as a researcher and is also the project manager for digital currencies and stablecoins at the Observatoire de la Finance. He is also the author of a book on monnaie et citoyenneté, money and citizenship, and an expert on stablecoins and digital currency. So a very warm welcome to the panel.
Thank you.
And I would like to launch in right away to our first round of questions. And perhaps I would like to pick up where we left off in the first panel, which is really the stablecoin issue. We've heard a lot about the aspects of stablecoins and how they could be useful to users, to consumers, to the general public. I would quite like to take a different tack here and now basically get some assessment. Could a stablecoin, whether it is the Libra project or another, could that be the emergence of a global, privately organized, privately issued currency? And if that is the case, what would actually be the big picture issues that such a new privately controlled currency could create in terms of financial stability, in terms of monetary policy, even monetary sovereignty, and how would they perhaps be balanced against the purported benefits of such a stablecoin, like financial inclusions and cheap remittances and cheap cross-border payments? And that I would quite like Virgile to perhaps start addressing that question.
Thank
Virgile,
you, Christian.
The floor is yours.
Thank you very much, Christian, for your introduction, and hello to my co-panelists. And so thank you for this first question. Indeed, I think if Libra is implemented, which it will be most probably, this will be quite a historic and unprecedented event, because it's the first transnational currency carried by a group of private companies. We have a few historic precedents, actually, of private monies, especially, for example, in the 16th century in Europe, but it was never of that scale. So, but I would say, although it is unprecedented, I think this project is not really surprising, because it is fully in line with the current development of capitalism, which in my view combines three forces. The first one is the power of capital. The second is the power of technology. And the third one is the power of networks. And the combination of these three forces will give an important strike force to Libra. It will be used, as you know, across Facebook's payment offerings like Facebook Pay, WhatsApp Pay, Instagram Pay, with rapid access to 100 million of customers. So Libra could easily attain mass adoption across multiple countries. So I think this is an important project. It could well be a turning point in the evolution of money, but we should be clear. This is a commercial enterprise, and despite the promise of efficiency gains and financial inclusion, the primary motivation of the Libra project is probably to compete with banks and to reinforce the business model of Facebook by creating a global ecosystem denominated in Libra, which will de facto challenge traditional sovereign currencies. But to answer the second questions, yes, I believe that if it is successful, Libra will result for the first time, maybe in history, in a fully private currency at the global level. So this is really an important step. But it doesn't mean that Libra would qualify as a real currency or money, in my view, because it might not be able to perform the traditional three functions of money: means of payment, store of value, unit of account. I believe that Libra will essentially be a new means of payment, especially for cross-border and online payments, but not necessarily an alternative store of value, in the sense that I don't believe that users will replace their euro deposits or their cash with stablecoins. So in that sense, Libra might be better described as a payment system that would be convenient only for specific use cases and user segments, but I would not describe it as a new money in itself. Now, regarding the potential opportunities and risks of this project, if you read the reports of central banks and regulators, the list is very long, so I won't go through all of them, but of course, the main opportunities of this project, in my view, it's for cross-border retail payments, which have remained relatively slow and expensive. Also, of course, online payments, because especially for young generations who are using social networks, who are very at ease with Facebook and that kind of networks, and they don't want to go to a bank and spend 1 hour opening a bank account, so they might easily use a digital wallet at Libra and use Libra for online payments. So there's a big potential there, I believe. And also probably for future applications like programmable money, smart contracts, maybe Internet of Things, of that kind of potential applications. Regarding the risks, I would say there are several economic risks. One of them is liquidity risks. It concerns the management of the reserves of Libra. For now, the founders of Libra say that there will be 100% backing of the system, but it could change in the future. So if they decrease the ratio of backing, we could have liquidity runs on the system, which could create instability. We have also some macroeconomic risk, especially regarding monetary policy, because if several important economies adopt Libra in the future, this could have the same effect of dollarization. So the monetary policy of some states could be constrained and limited by this system, by the implementation of Libra. There are also some exchange risk because despite the name of stablecoin, the price of the coin is not fully stable. Actually, it will fluctuate within a very limited margin, but it will fluctuate. So you have no guarantee that if you sell your Libra, you will have the same amount of money when you bought your Libra. And there are risks of tax evasion, of course, and risk of financial instability, in the sense that, as I said, there are issues. I mean, there are risks with the management of reserves. There could be runs. There are risks of cyber attacks, theft from wallets, for example, that could trigger runs, and users could lose confidence in the system. So there are many different issues that could happen, could actually trigger runs, liquidity runs, and create a contagion effect to the financial system. So I hope I was not too long to answer your question, but
there are many aspects to consider. So thank you, Virgile. That was a sort of a very comprehensive overview. I think of the many risks that you mentioned, perhaps if I may pick out a couple of them. One is that, as you said, there is this liquidity risk, which obviously has to do with the fact that the Libra and other stablecoins rely on backing up the coins that they have in circulation with assets, and these assets obviously are usually securities, short-term securities, government securities that are issued in the respective underlying currency. And that obviously is an issue if there is a huge player who will every day intervene in that market, buying and selling these assets at the scale that Libra and perhaps other operators are. The second issue is, as you mentioned, you said dollarization. I think perhaps casting it broader, the issue is of currency substitution. So in some countries, essentially, the local currency may get overshadowed by the widespread adoption of a stablecoin that is referenced to a currency that is no longer the national currency. And obviously, these are the big issues that central banks and governments care hugely about, which then brings me to our next question, which is essentially, governments and central banks are now thinking very hard about issuing digital instruments on their own, which are the fabled central bank digital currencies, or CBDCs. Now, they are supposed to address most of these issues, if not all of them, most of the issues that Virgile just mentioned. Jürgen, could you perhaps give us some insight on the concept of CBDCs and how they differ from this private concept of a stablecoin, and how they, we hope, would perhaps address some of the shortcomings? And perhaps also on the flip side, as we all understand, no benefit comes without a shortcoming or a disadvantage. So perhaps you could also shed some light on the inherent issues that a digital central bank currency would involve. The floor is yours.
Thank you, Christian. At least I can try my best. So just let me start with what actually is a CBDC. As you know, or you might know, you should know, we have issued a report on our vision and our plans to on October 2nd, we issued a report on the digital euro. We defined the digital euro as a simple and risk-free digital means of payment. That's our core definition of what we understand by saying digital euro. And to distinguish this from other private money or cryptocurrencies, I would like to have a threefold distinction. So, and coming from the balance sheet of the private sector or central bank. So, this digital euro, a digital means of payment accessible to the citizens, would be a liability of the central bank in digital form. What we currently have is liabilities of the central bank in physical forms that is accessible to the general public, that is cash, banknotes, and we have liability of the central bank in digital form, that is reserve deposits with the central banks, with a limited number of eligible holders, mainly banks. So we have the digital form and we have the accessibility to everyone, but the combination so far we don't have. A digital euro would be a combination of the two features, accessible to everyone and digital. However, it would be a complement to both cash and deposits for the banks. It's not intended to replace any of these, so it would be a complement, very important. Different from that is a liability to a private entity, mainly the banks. So only, let's say, 5 to 10% is central bank money in our payments universe, in our money universe. The major bulk is commercial bank money created by the generation of loans. So that's a liability to a bank, mainly. So that's a major difference. And then last but not least, we have the cryptocurrencies, which are basically no liability. That's the major issue. Now, Bitcoin and the like are effectively no real liability against anybody. That's the major point. The stable coin is something in between, and as Virgile already pointed out, it's not, in our understanding, really a currency. It would probably be a means of payment, and the concerns that he mentioned are fully shared by us too. Now, but you also asked for the risks that come along with a digital euro. So let's face it, these are there. So first of all, what is currently quite difficult is to explain what are the advantages, or what would be the advantages to a private citizen compared to the existing private monies and payment services that have that you have already and that will be there in the future. So to make clear the superiority of central bank money vis-a-vis commercial bank money, in an environment of low interest rate and in an environment of quite stable banks with good, hopefully, regulation. So the advantages of a CBDC vis-a-vis commercial bank money with excellent and modern payment services, front-end solutions, that's a challenge. The other big questions that we currently have is there's this doubt that central banks, including us, actually wanted to abolish cash. So we repeat that this is not the intention. No one wants to abolish cash. It would be a complement. And the last technical issue that has gained some prominence is the fear that the introduction of a digital euro would foster or facilitate bank runs structurally or in times of financial crises or turbulences. So there the idea is, if you have digital monies, so commercial bank money and central bank money, why would you keep your money with a commercial bank on your private sight deposit instead of going to the central bank? And also, so in general, and also when there's a bit of financial stress, the risk that is already now that people will run to the ATMs and withdraw too much cash might facilitate bank runs and problems there. With a digital euro, this risk would be elevated. So structurally shift to the central bank and then acceleration of bank runs is one of the risks that we see. Having said that, we are, of course, reflecting on how to mitigate those risks, and there are a couple of potential mitigations. For example, having a threshold of on the amount of digital cash people could hold, or also have a tiered system of remuneration, making the digital euro less attractive in terms of remuneration compared to other means of payments in the current universe. Maybe I stop here and we can pick up details of that later.
Thank you, Jürgen. I mean, you mentioned a number of quite interesting points, and the one that I think probably provides the most interesting hook going to Gabriel. You just said it's difficult to explain what the advantages of a CBDC for the general public would actually be, particularly in the good times. Now, the Riksbank has obviously sort of experimented and is piloting an e-krona, and has been for quite some time. And the Riksbank, I think, has also been quite vocal in explaining why it does it. So, Gabriel, the floor is yours. Why are you doing it?
So, one of the questions that we often receive now is why we were so far ahead, because now almost all central banks are looking into this question. And so we didn't know about Libra, we didn't know about many of these events that are now taking place. When we started this back in roughly 2016, 2017, we started looking into this. And the main driver was quite obviously the reduction in cash usage among Swedish consumers. And the usage of cash in Sweden declining quickly for the last decades, and a very small part today and recent years have been of the actual payments made have been in cash. So let's return to Jürgen and his explanation about these different kinds of money and what is cash. And as Jürgen said, it is state money in physical form. And at the moment, no citizen can hold digital state money. Banks, of course, can have digital state money through the real-time gross settlement system that the central bank operates. But citizens, ordinary consumers, can't access and can't make payments, most importantly, with the state money as it is today. And instead, they rely on their digital electronic payments on money that is the liability of private companies, mostly banks. So this at least raises a question. So if we've had a system, at least for 100 years, in some countries more than that, in which the state produces most of the money that people actually use. And now we are quickly going into a country in which, in Sweden in particular, situation in which money is primarily produced by private entities and the liability of private entities. So it raises the question, so is this something that it's an obligation of the central bank to look into this question? What happens if we do this? Are there potential problems? And if there is a problem, can the state then simply upgrade its system? Offering physical cash, wouldn't it be a natural step for the state to offer digital money instead? There was some hitch there.
We can hear you.
Yes?
You're breaking up a little, Gabriel, but we can hear you.
Let's see if I can move the computer. There has been problems with my connection. Wait a moment. I will try to move a bit.
Right now we can hear you.
Sorry. Excellent. Can you see me as well?
Yes, indeed. Please do carry on.
Excellent. I'll carry on. So that basically is the project. In its beginning, this is the setting. A huge shift from state money to private money, basically. And is this a problem? And if it is a problem, what could a state digital currency help to mitigate in this? So there has been four main risks that has been identified in the project, and it's firstly about trust. You spoke about trust earlier, and if we have a system in which we're basically used to the state having sort of being the guarantee of trust being kept up in the system, and what happens if money is almost entirely run and operated by private entities? That's the first one. The second is resilience and crisis preparedness. Can we assume that a payment system that is dominated by private actors will devote sufficient resources into these issues? The third has to do with access to payments among all groups in society. There are groups, for instance, the elderly, which are already experiencing problems in Sweden in making the payments that they want to do, because stores, restaurants, etc. Put up these signs which says we don't take cash, and they can't pay with cash. So that is a concern. The fourth concern has to do with market power and the concentration, market concentration. So we identify that in the payment system there are advantages. You spoke about Facebook and its millions of subscribers and users, and that this would make it possible for Libra potentially to acquire a large part of a large sort of market share in the future. And that sort of goes into this thinking that, yes, there are advantages, network advantages of being sort of the biggest. That sort of confers extra benefits. And if that is the case, there are two potential problems. One is, of course, that this might lead to monopolistic practices in the future. You could even subscribe your services today in order to capture these sort of market shares, which would make it very difficult for competitors in the future. And it could also, now we're seeing a huge, and that is sort of, and so that's the fourth one. You could also have, you could also see a slowdown in innovativeness in the future. So I'll stop there and continue.
Thank you, Gabriel. I think that that was a very instructive overview of where we go, sort of why we've got on the one hand this private initiative, and why sort of the public sector is thinking about offering an alternative. Perhaps drilling a little bit deeper into Jürgen.
Yes.
Did you have a by all means, please? The floor is yours.
Just to add one point to Gabriel, so the assessment description of the situation and the pros or the needs is very clear and shared completely. But I want to highlight one difference between a country like Sweden and the euro area. So Sweden is a small, sorry for the word small, but in relative terms, economy as such is a different animal from a huge area compared to the euro area. So our currency, for example, the euro is held as a kind of store of value also outside the euro area. So you, like the dollar, euro banknotes are kept as assets elsewhere. So that's, for example, one very important issue, and that also explains why so far the usage of cash is trend-wise in the Eurozone, but the order of magnitude is completely different from that in Sweden, for example. So currently, the number of transactions in shops in the euro area, so number-wise in shops, it's still 3/4 is done by cash. That the latest figures are from November last year, so before the pandemic, but we are not there yet. Having said that, we observe the developments elsewhere, like in the Nordic countries, like Sweden, and even more dramatic, if you will, in Norway. And as this is a huge logistical organization project, if it will be realized, we have to be prepared for the need if it once arises. So we are lagging behind the developments in Sweden and elsewhere, but we definitely have to be prepared for developments that we observe elsewhere.
Thank you, Jürgen, for sort of this intervention. I think that it's quite useful to really sort of see how the needs or the background and the circumstances are different from jurisdiction to jurisdiction, even within Europe. Would be quite interesting, perhaps as a next step, to drill more deeply into the concepts, because I think for probably many of our audience, the notion of a stable coin on the one hand and the central bank digital currency on the other is still sort of fairly abstract. We're looking at the stable coin in the first instance. The idea is clearly, as we said, an electronic representation, a tokenized representation based on a blockchain of an existing currency. Although clearly the Libra project has gone one further in its initial iteration, at least, and proposed to effectively reference this token, this coin, against a basket of global currencies. But in both cases, there is basically a privately issued token with an underlying reserve, which in an ideal world would always be one-to-one backing up that token. But that process, and I think we've only briefly alluded to that in the previous page, has a lot of issues, because this reserve for a stable coin, which could potentially serve hundreds of millions, if not billions, of people, would clearly be a huge player in the international markets. Perhaps then. A question to Virgile here. Could you perhaps sort of give us a bit more of a sense how this would all play out, how this reserve of this private stablecoin operates in the markets, what it does, how it affects then at the end of the day the citizen, and also what this reserve actually represents and who stands to gain the profits and losses from that reserve. Virgile, the floor is yours.
Thank you, Christian, for your question. Yes, indeed, the mechanics of stable coins is quite complex, and it's true that the management of the reserve is very important. So usually we make the distinction between two different mechanisms to manage reserves. They are the so-called asset-linked stablecoins. So it's stablecoins which are backed by assets, as you mentioned, fiat currencies or short-term government debts. And these stablecoins attempt to achieve a stability through a peg to a single currency or a basket of currency. But there are also the so-called algorithm-based stablecoins. These are managing, trying to attain stability through an algorithm which is increasing or decreasing the supply of stablecoins in response to the demand, to the changes in demand. But most stablecoins are asset-based. So if you have this, but in both cases, assets or algorithm, you have to buy or sell assets, and you have to have an investment policy. Of course, this is a complex issue, and there could be some interactions with financial markets and monetary policy, as I mentioned a bit earlier. And there are also issues with, I would say, in a way, there's some kind of almost conflicts of interest, because the managers of the reserves, they have they may be tempted to invest in risky assets to have high returns for the reserve. But on the other hand, the users of the stablecoin, their own interest is to have 100% backing of the reserve, because it's the safest way to manage the reserve. And in case of financial stress, it's better to have 100% backing of the reserve. So we have some precedent case, I think, with the stablecoin Tether, where the reserve at the beginning was 100% backing, but then it changed, and the managers of the reserve invested in debt or more risky investments, and then they had a few issues. So this conflict of interest is problematic and could create tensions. Now, of course, usually the interaction between the management of the reserve and the financial markets, usually we make the distinction between two mechanisms. There's the risk of a liquidity run impairing the operation of the stablecoin. So as I mentioned previously, there's many reasons why there could be liquidity runs on the stablecoin, and this could create instability. But there's also the risk of contagion to the wider financial system. So these two risks could create wider financial instability. Also, the question of trust is very important, because in all kinds of monetary arrangement, trust is key to the stability of the system. And with the global stablecoin also, the question of trust is important. Depending on the stablecoin, we have to ask, investigate who bears the risk. Is it the issuers or the end users? But in both cases, the question of trust is central. Users may lose confidence in the system for various reasons. And also, there are some issues. The management of the reserves could have an impact on monetary policy. This I mentioned a bit already earlier, but it could impact the transmission mechanism of the monetary policy. If this global stablecoin was really widely used, I would say, it's not. If it's a national stablecoin, it would not have a big impact. But if it's like a Libra kind of a stablecoin, that could have an impact. A global stablecoin could also increase capital mobility, and this could have an impact also on the transmission of monetary policy. And that's the issue also. There's the issue also of a currency substitution that you mentioned, that could also impact monetary policy. So I mean, I would say, to sum up, I mean, all the risks related to the management of these assets could impact the stability of the system. And the problem is also this conflict of interest at the heart of the management of the reserves.
Thank you, Virgile. I think this is an interesting point. So we have we've potentially a conflict of interest between on the side of the operator, and we've also got an issue that they need to manage a reserve. They need to hold and manage a reserve, and they cannot. They effectively sort of are in this intermediary role. The central bank does not have to hold a reserve. The central bank obviously is its part of its job is to create money, to control the money supply. So from that perspective, this is one element that the central bank digital currency does not have to address. At the same time, the central bank still obviously has to strike its own balance, and this revolves around what we said around the issue of trust and the balance between maintaining a role for the private banking sector and privately issued money, and providing this sort of trusted currency of its own. And there are various ways of trying to strike this balance. Perhaps, Jürgen, could you introduce us to some of these thoughts, how central banks, and the ECB in particular, are trying to strike this balance to ensure that the banking sector, in some way, shape, the private banking sector maintains its role, but there is still this CBDC option?
Yes, I try to also state that even more clearly than before. We are currently just in a pre-investigation phase, so we hasn't even decided whether or not to introduce such a digital euro. So we are investigating, but of course the demand for information is so high that we are still discussing this. So let me add one point to what Virgile just said. I agree with basically everything he said. If we compare the CBDC, the digital euro, to a stable coin, which is private money, he mentioned already the problem that you have to keep the exchange rate, if you will, stable. Then if you have sort of a peg or a currency board with, and you want to minimize the liquidity risk, you have 100% coverage. Now, if you look, for example, at Hong Kong, with a very successful history of currency board, I think they have a 110 or 115 in order to keep that exchange rate really stable. So this is a central bank. Now, a private company that is doing this endeavor has either a profit that comes with the incentive to reduce this level of coverage. So you go down below the 110 or even then below the 100, and then you increase the liquidity risk and the whole thing tends to become more unstable. That's risk one. Or a private company might have an interest in other things like your data, both of which speaks very much for the superiority of a central bank solution, a public solution, compared to a private one, if the need arises to issue one. So that's an important point I wanted to make. The second thing is, indeed, whereas we have to tackle the issue that some people think the digital euro might not be too convincing to the citizen, others fear it might be too successful, it might crowd out the private sector and lead to disintermediation and crowd out the banks. So in our investigation and experimentation, we have to tackle both risks and have to strike a balance. We certainly are not keen on taking over the role of allocating credit and loans. So we are convinced the central banks are not better placed to take a decision which companies and which consumers are supposed to get a loan. Second, the innovative power of the private sector we value very high, and we don't think that a central bank, a bureaucracy in the end, is better placed to come up with innovative solutions at the front end, at the design of devices and maybe applications. So we are not intending to crowd out the private sector. We are not intending to disintermediate, to crowd out the banks. That's one of the key principles in the experimentation and investigation phase in which we are now. In terms of how the thing could look like, there are basically two potential options. One is a kind of a real representation of cash in digital terms that would work like a token. We call it Perret because a couple of virtual and crypto assets are associated with the word token, so we call it Perret solution. So That's one solution. The other would be account-based. So basically, you would have citizens or whoever has a CBDC, a digital euro, would have an account at the central bank, which is currently limited to mainly to the banks. So and a combination of the two of them. How that would be then the underlying, and then you would have private companies, payment service providers, fintechs, you name it, that would use this underlying in order to come up with front-end solutions, being in probably competition with providers of payment service solutions or commercial bank money solutions. That there will be an increased number of choices how to pay. That's basically then the visionary universe of means of payments. So let me reiterate again that the risk of crowding out the banks in terms of allocating credit is something we're not intending to, and the risk of crowding out private solutions on the front end side is also not in our interest. We appreciate the superiority in terms of innovating of the private sector very much.
Thanks, Jürgen. So we're basically looking at these various options that you just described. So there are tokens to be carried in wallets effectively, or there are accounts, almost like a deposit, directly with the central bank. There are questions on how you intermediate, how you distribute this to the actual user. There are questions how whether these should be interest-bearing or not interest-bearing. A deposit normally is an interest-bearing amount of money. There are these questions about tiering that you mentioned, Jürgen, that perhaps sort of some of it could be structured as a deposit with interest, and some of it could be more as a wallet, no interest, mobile. Gabriel, what has kind of informed the Riksbank? What have you found out as part of the pilot project? And I reiterate, it is a pilot project. It's not out there yet. So what has guided your thinking on the pilot so far? And which choices, does the pilot currently, enshrine and follow? And what is the thinking behind that?
Yeah, so I'm going to be brief now because we're running out of time, and it would be good to let in the audience at some point. So what I can say is I agree very much with what Jürgen has said. So that's sort of that takes a lot of time out of my sort of burden because I think there are absolutely crucial points that he points out. And as you said, the pilot, there's been no decision to launch e-krona yet. So the pilot should be seen not as a blueprint for some future existing e-krona. It should be seen as a way to explore the technology, different technologies, and to explore various trade-offs that you can sort of identify once you build something like this. So what I will say is that, and again, it shouldn't be seen as an indication of any design decision. But what I will say, I will address this question about intermediation and different tiers. And so the pilot is a two-tier structure, in which it has an architecture with a DLT-based system, which is operated by the central bank, but it relies on private intermediaries, banks, etc. So it takes into account this sort of ambition not to do this sort of without the intention of sort of crowding out the private sector, and in fact it sort of would rely on that sort of, again, that shouldn't be seen as a decision that this is the way it's going to look like in the future if it exists. It should only be seen that that option is being explored through this pilot, and I think at the moment I'll wait there, and then we'll see if we can get more time to discuss various other stuff.
Thank you, Gabriel. So at this point, it notched up quite a few questions from the audience, and so I would quite like to dip into them. And obviously, some of these matters have been, and some of these matters have not been, or not sort of conclusively been addressed in the interventions so far. I think sort of one to perhaps start with, because it is a recurring issue, is clearly the coexistence of the private bank and the private credit creation with the central bank issued currency. And some of the questions here evolve around, for instance, the question, on the one hand, yes, the CBDC does not per se remove the ability from the private sector to issue loans, but would it not de facto limit the tendency for people to go to use private sector loans if there is sort of lending available from the central bank? That's one question. Then, as a corollary of that, to the extent that private banks sort of continue to create credit, there is always the risk of private banks overextending themselves and getting into trouble. So there is always the risk of banks effectively failing. And if these banks are big enough, they tend to be, despite all the frameworks that we currently have in place, they tend to be supported by the government and by the public sector. At least that's what the experience that we have had so far. And that is a cost. And the question, I think, from the audience here was, to what extent actually does potentially saving on the cost of rescuing failed private banks compensate for the disadvantage of having, or the limitation on having sort of the private sector or the private banks there as a flexible and market oriented source of credit. So does the central banks factor in the cost of rescuing private sector banks into this whole debate? Well, any takers?
May I start?
Please do.
Thank you for the opportunity to make that even clearer than I thought I had said so far. In this context, speaking about the ECB, but probably it applies to the major central banks as such, we're talking about when we talk about CBDC, we're talking about an instrument to pay. So the means of payments function is addressed. It's not about financial stability. It's mainly payment. So any digital euro would need to come up with the potential to do proper and effective monetary policy should not be mitigated, but its aim is not to improve somehow or change the monetary policy stance. Likewise, the amount of credit being provided by the private sector, by the banks and saving and loans association would not and should not be affected. The central bank would not give credit to anybody. So that's not supposed to change. So like currently we have cash. When we issue cash, you can go to your bank, have it deposited there, and based on that additional central bank money that the bank has, it can grant additional loans. So that's how private money is generated. The replacement would be that cash is substituted to some extent in terms of quantities by a digital version, but not by the amount of money that's generated as commercial bank money by the commercial banks in either direction. So money creation as such is not intended to be affected at all.
And I can just add a little bit there quickly that I mean, it's always been the case that regulations, capital regulations and such things, and monetary policy in terms of setting the interest rates are the main sort of ways in which the central banks try to control or the governments try to control money creation in the private sector. So it's likely to continue to be that. Although what they are afraid of, some banks and critics, is of course that deposits, which is a form of funding for banks, will be less available. On the other hand, banks have other forms of funding as well.
Yeah, if I may add just one thing, I think the question was an excellent one, and I believe that CBDC could potentially contribute to reduce the too big to fail problem. Because in case of the failure of a big bank, if we have a CBDC system, then the payment system would be able to continue to work. It would maybe less be impacted by the failure of a big banks. So in a way, maybe CBDC could actually increase financial stability or maintain financial stability in the case of in times of crisis, or if a big bank goes bankrupt. So I think that's a very good point. And on the other hand, also the other part of the question, I also believe that private banks can remain attractive. I mean, the deposits of private banks will still be attractive even if a CBDC is implemented, because probably you won't have any interest on a CBDC wallet. Maybe a private bank can maintain some other services, especially credit, because CBDC is not designed to grant credit, and also some other innovations that banks can do. So I very much agree with what has been said on the CBDC. I don't believe it will be disruptive for the banking system.
Thank you. I've got another complex of questions here, and they revolve around financial inclusion on one hand, and I would say currency substitution on the other. And if I may summarize, we've had several members of the audience effectively sort of asking, could CBDCs on the one hand be a means of making cross-border payments and remittances cost-effective for individuals, for members of the public, which obviously, and that is another question that was raised, which obviously requires members of the public to potentially have access to CBDC or CBDC tokens or accounts with a central bank that perhaps is not their own central bank. And if that is the case, then would that potentially be an issue or create issues of currency substitutions? So effectively mirror the issue that we've identified with the global stablecoin.
So I can just quickly say a few words about that these are questions that I think central banks will work very much with in the next year, I think. Cross-border, can it be used? Can it be? Because I think there is a great understanding now that, which is a consensus on that, cross-border payments today isn't function as it should, which is also the driving force behind something like Libra. So I think really wait 6 months, a year, and there will be a lot on this, I think. Just briefly. So stay tuned.
That is a very interesting but cryptic answer from Gabriel. Do we have would Jürgen or Virgile venture something more detailed? Because clearly, you know, we are watching the space.
Yeah. Yes, I believe that the cross-border issue is very important for CBDC, and I'm pretty confident that CBDC could improve the effectiveness of cross-border payments, but this would require lots of international coordination, which would be which would probably take some time. I think it would be a very good point for CBDC. I think I missed the other part of the question, Christian, because
yes, it would come potentially as a way of creating currency substitution risk.
Yes, that's probably there's a risk in some emerging economies but although actually if you have a CBDC, it's not like a global stable coin, because the CBDC would be labeled in the monetary unit of the country. So with the CBDC, I don't really see a risk of currency substitution, in the sense that, not like with Libra. A global Libra would be could potentially substitute some local currencies in some maybe emerging economies. But with a CBDC, I don't really see that risk as really important. But I don't know. It is labeled in the same monetary unit, as the way it is implemented. I don't think it would really substitute the currency.
Maybe I agree very much with everything that has been said by the other panelists. Maybe to add one or 2 points. So in terms of cross-border payments, indeed, the prevailing correspondent banking solution is maybe not the most modern one, and there on the international level, there's a lot of work going on to improve that. If that is then based on cooperation between the central banks outside a digital central bank currency solution, would be an option. So you could have on the back end and the settlement, you could be much faster, done by the central banks cooperating without a CBDC even, or that's in parallel to be investigated if a CBDC solution improves the cross-border payments of many people. For remittances, in terms of the price, one has to take into account that certainly a digital solution, be it Libra or be it a CBDC, could lower the cost, but the huge part of the cost of solutions by incumbents, so offline solutions, if you will, is mainly triggered by the monitoring in terms of preventing a money laundering issue, terrorist finance, and the like. So the huge cost that you have to bear when you transfer money to Africa, Asia, or elsewhere, it's because those companies who are doing that, they don't only have a huge, they have cost in terms of risks that would violate global regulation. And an innovative payment solution for cross-border payments will in the long term probably not escape the challenge of tackling those issues also. Final word on inclusion that was raised. It's a double-edged sword. So while a digital solution will, or hopefully will, include the very young who maybe don't have an account but have other means of other devices to pay at hand, that would increase financial inclusion. There is also the risk of losing maybe the elderly who have a tendency to prefer cash when they pay. That's definitely one of the reasons why the major central banks say, even when we introduce a CBDC, we continue to offer cash, not to have a negative impact on inclusiveness for the elderly, for example.
Great, thank you. I'm mindful of time. I would still quite like to slip in one last question from the audience, which is what would prevent a third party, and presumably that is meant to be a private commercial third party, to propose a stablecoin based on CBDCs if the CBDC in itself is too restrictive and cannot be sort of used openly. So how would could basically a third party create a CBDC backed stablecoin, for instance, for use in a decentralized finance application?
I could take a stab at that. In a way, you could say that modern stablecoins, in a way, is like that, because if you look at the Libra white paper, it's almost the stability comes from government securities and government fiat money, etc. So in a way, so the only way it could be stopped if it's designed not to be able to use like that. For instance, if it's designed that you can't, as a foreigner, hold that CBDC. So if the decision is to create something that will be possible to be used for that purpose, then it's possible. If the design choice is not to make it possible, then it's not possible. So, but theoretically, there's nothing to sort of exclude that possibility. In fact, it might even be a not totally bad idea from the perspective of some private actors, because basically that's what Libra already is, although the assets are different.
Yes, I fully agree with what Gabriel said. And actually, when you read the Libra white paper, they already anticipate the implementation of CBDCs and they explicitly mention CBDCs as potential assets for backing Libra. So it's already well stated in the white paper of Libra.
Which brings me perhaps to a follow-on question: How would you consider being able to enforce that design choice? If, as Gabriel was just saying, you actually make that design choice for CBDCs that you would not want to let somebody tap into CBDC as a means of backing up a private stablecoin. How would you go about doing that?
You could set a limit. So if your intention is to basically have a similar of payment like cash, you could put a threshold lid on the amount that is allocated to each individual. So that could be one option, or you can. That's the amount that you want to have in circulation. You can then set incentives by different remuneration. You could even exclude private companies and the like. Having said that, that would of course not prevent an issuer of stablecoin to back its own currency, if you will, by purchasing real assets. So when we talk about CBDC, we are not thinking of an investment asset. We are thinking of a currency with a focus on the means of payment function. In an environment of very low interest, the difference may be not too big, but in general, if you want to peg your currency, you normally would go for an asset that yields interest and not invest and don't back your currency by cash or cash-like most liquid but for payment purposes invented currency. So normally you wouldn't do that.
Well, thank you. I'm mindful of time. We are sort of drawing to the close of our allotted time, and obviously, sort of we've only got sort of halfway, not even. We've only really scratched the surface of that discussion. In fact, the debates in those two discussions, I think, have illustrated that we're only really at the start of something that is going. It is very multifaceted and is going to take some time to unfold. The discussions will be among legislators, among central bankers, among all manner of other stakeholders. They will be hugely technical also, but what is important to mention here, and for our purposes today, these technical discussions are hugely important for the general public. They touch effectively every citizen and will be very, very central for the way how we deal with money and payments in the future. Who issues the money that we use? How safe is the money that we use? Who gets to regulate and control the money that we use? So how can we make use of all these exciting technologies like DLT and still at the same time, make sure that money continues to be as safe and reliable as we've actually, and boring, in fact, as we have got used to. So all of these questions, I think, are to be worked out. And I would say, have to be worked out with a very, strong participation from the public sector and a loud voice from civil society. And at Finance Watch, we intend to provide one of these voices on behalf of our members and on behalf of the general public. So let me thank you. Let me thank the panelists. A loud virtual applause, please, to the panelists. Many thanks for participating. And thanks to the audience for their sort of lively and active involvement and really very, very inspiring questions. And with that, I'd like to hand over to Thierry.
Thank you very much, Christian, and thank you so much to the 6 panelists we had this morning. You can be assured this was extremely useful food for thought for the future debates and all the discussions and work we're going to be doing on this. So we will keep in touch with all of you and keep on the discussion as well as with the audience we had this morning. It strikes me that the common denominator of the debates and exchanges we had this morning has been, I think, the word trust. We've addressed many different issues and certainly 2 big different types of instruments, stable coins on the one hand, central bank digital currency on the other hand, which are, as we all know, and we've all understood, very different animals, but with the relationship. But the common denominator is really trust. And if I can generalize a little bit, history tells us that means of payments are and has always been an expression of sovereignty. And that question of the expression of sovereignty is of particular importance, in my view, when I'm thinking stable coins here, but when a stable coins has a global scale or the ambition of achieving a global scale. And we have to ask ourselves whether what Adam Smith 2.5 centuries ago described as the fact that was in his theory of moral sentiments, the fact that private actors, it is not in the nature of private actors to look after the public interest, whether what Adam Smith said 2.5 centuries ago is still valid or not. The world evolves, the world moves on, so perhaps Adam Smith is no longer valid. But if we think that Adam Smith is still valid, we have to ask ourselves to what extent we want to entrust private actors, in particular private actors with a global reach, with the public interest, with looking after the public interest. If I were to use somewhat, I admit, provocative expression, do we want to give monetary sovereignty to Christine Lagarde or to Mark Zuckerberg? The jury is out. But I think this question has to be resolved and kept in mind when we at EU level will go into the discussions about how we calibrate MiCA, and the MiCA regulation, as there's always a danger when you get into discussions about calibration of regulation, that you get caught in the technicalities of the text. And there are many dimensions of the, that are very technical dimensions. But it seems to me that you first want to answer the big question, which is the one I just raised, I think. And then the technicalities can be relatively easily deducted from the answer to the big question. So I would put that as a basis for the further work we need to do on this. As all panelists said this morning, this is work in progress, and the work is only starting. I shouldn't say only starting, because there's been a wealth of tremendous contribution from many different angles and horizons of the past few years. But we have much more to do. But please, let's keep that big picture in mind before we get into the technicalities here again, because answering the technical questions will be easier if we have the big picture in mind. Thank you so much for being with us this morning. Thank you to our audience. It was a pleasure to be discussing with you. Never hesitate to get in touch with Finance Watch. We're here to work with you. We're here to think with you. We're here to debate. So please reach out to us. And if I may, on behalf of the entire Finance Watch team, not only thank again our panelists, but Christian for having brought together this crowd and being a super moderator for this session. Thank you very much, and please let us keep in touch. Bye-bye.